The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon. This is Ken Robinson from CFA Institute, and on behalf of BSAS and the Quantitative Investing Committee, I would like to welcome you all to today's webinar, A Periodic Table of Risk Measures. Before we get started and introduce Carl Bacon, I need to go over a few housekeeping items. We will begin with Carl's presentation, which will be about 20 to 25 minutes. After the presentation, we will conduct a Q&A session, and the webcast will conclude by 1 o'clock at the latest. We will take questions at the end of Carl's presentation. However, you can still send in questions at any time. We will do our best to accommodate as many questions as we can. If you would like to ask a question, please submit it using the question feature on the GoToWebinar toolbar on your screen. All attendees will be muted during today's presentation. For technical help during the webinar, you can access the Help menu, also on the GoToWebinar toolbar on your screen. Carl Bacon joins us from London today. For those of you who don't know Carl is the chairman of the StatPro Group and runs his own consulting business providing advice to asset managers on various risk and performance measurement issues. Prior to joining StatPro, Carl was the Director of Risk Control and Performance at Foreign and Colonial. He was also the Vice President and Head of Performance for JP Morgan Investment Management in Europe. And prior to that, Carl was the Head of Performance for Royal Insurance Asset Management. Carl is also the founder of the Freedom Index Company. He's a longtime GIPS and CIPM volunteer, where he currently serves as a member of the GIPS Executive Committee. Carl is the author of two well-known books, Practical Performance Measurement and Attribution, and Practical Risk-Adjusted Performance Measurement. And with that, I'd like to hand it over to Carl. Carl, thanks for being with us today.
Thank you, Ken. If somebody could hand over the PowerPoint presentation to me, that would be wonderful. Thank you very much, and good afternoon, everybody. A periodic table of risk measures. You might wonder why we'd want to have a periodic table of risk measures, and basically there are far too many risk measures in use today or potential use today. So I wanted to try and bring them all together on one page. Fundamentally, most of the risk measures that most people use are all the same design. It's a measure of reward in the numerator and a measure of risk that people are concerned about in the denominator. So they do all easily fit onto one page. You can easily see how they're all related if you try it into a structured order. And it also allows you to fill in the gaps, actually. If you put them in a structural order, you'll notice there are a few gaps, or at least I, when I first attempted to do this, noticed a few gaps, and I was able to actually fill in a few of those gaps as I did some additional research. So the risk measures that I'm going to introduce very slowly to you in the periodic table are in four basic groups. We have the basic descriptive statistics, which we borrow from other industries and are used by almost everybody. Then there are the core appraisal measures, which form the center of the periodic table. Then there are risk-adjusted performance measures, where we adjust a return for the risk that we're taking. And there are various miscellaneous risk measures, which we wouldn't use necessarily to appraise performance, but they do give us a little bit of extra information about the way a portfolio manager's returns are distributed. Might be useful in sort of secondary assessment. Of course, there are two basic types of risk measures, ex post and ex ante. Ex post risk is after the event, is historical risk, relatively easy and straightforward to calculate. Ex ante risk is risk before the event, it's prospective risk, a forecast of risk, actually much more difficult to forecast. Basically, we're going to take a snapshot of our current portfolio and look at the relationship between the instruments and the securities in that portfolio, and we're going to forecast the risk going forward. I'm principally going to focus on ex post risk measures in this presentation, and if anybody has any bright ideas for introducing ex ante risk measures into the periodic table, then those ideas would be greatly received. So Let's start with the most common. You'll all use the basic risk measure of variability. Actually, most people call this volatility, but I prefer the term variability. All I'm going to do on this graph here, I'm going to plot in ascending order, not chronological order, each of our monthly returns for our portfolio. Let's assume we have 36 monthly returns. I want to plot each of these monthly returns, and I can calculate the average monthly return. And what interests me is the variability of each of these monthly returns with the average monthly return. Obviously, if I add up these positive and negatives, they will cancel. But one thing I could do is I could treat these negative distances here as positives and calculate the absolute value. And that's what I'll do. I will add up all of these absolute variations from the mean and then divide by the number of observations. If it's 36 months, of course, that would be 36, but let's just say M. And that gives us a measure, not used very much. It's called MAD, mean absolute deviation. And it's not used that much, of course, because there's a more popular measure called standard deviation. That's the calculation of standard deviation there, and essentially all that we're doing, we are going to square these distances. We'll square those distances, which solves two problems for us. It converts these negative numbers into positive numbers in any event, and it makes the more extreme variations more significant in the calculation. So let's sum up those squared differences, divide by the number of observations that we have, n, and then take the square root. Because we want to get back to the same order we started with, we're using squared numbers, and then we take the square root. And that's a very common number. I won't talk today about whether we should be using n or n minus 1 in the denominator here. n minus 1 is Bessel's correction if you're using a sample mean. We're not using a sample of the population here. This is the entire population of returns, so this is the correct measure of standard deviation we should be using. There are two other descriptive statistics which help us better understand the shape of the return distribution, and that's skewness and kurtosis. And this is particularly important if you would expect the returns to be non-normal for such as hedge funds. The calculation is very straightforward. Just take the monthly return of the portfolio minus the average monthly return, standardized by dividing by standard deviation. Take the cube, sum up each observation, divide by the number of observations. And this calculation skewness measures the asymmetry of the return distribution. And obviously, if you have an extreme positive number, that'll give you a very, very, very big contribution to positive skewness. An extreme negative number, because you're cubing the number, you get a very, very, very big negative contribution to skewness. And rather obviously, if you have large negative result here, your returns are negatively skewed. And if you have a large positive number here, your returns are positively skewed. Kurtosis is an extremely simple calculation, seemingly a similar calculation, except we're taking the fourth power, not the third power. Taking the fourth power, if we've got extreme negatives and extreme positive returns in the return distribution, they both make very, very, very large contributions to kurtosis. So both negative and positive results, because you're taking the fourth power, give us a positive contribution. And it so happens that the kurtosis of a normal distribution is 3, but that's for another discussion. These four returns I've just described, so that's the average, the variability, the skewness and kurtosis, are the 4 moments of the return distribution. And the most important, of course, is the average return, and the second most important is the second moment. That's the square in there for standard deviation or variability. Then skewness is the third power, it's the third most important measure, and kurtosis, the fourth power there, the fourth moment, that's the fourth most important measure. So now we can start building our periodic table. We have the descriptive statistics we all use down that left-hand side. That's the average, the variability, the skewness and kurtosis, the 4 moments. I've added a fifth measure, which is a measure of systematic risk, which is beta. So those 5 measures give us a lot of information, very useful for understanding the shape of the return distribution. So moving on with those basic measures, essentially now there are 6 different types of appraisal measures which go into the main body of the periodic table, which are absolute measures based on the absolute return of the portfolio, relative measures based on the relative return against the benchmark, partial moments, 2 forms, just basically downside measures which ignore upside and just focus on the downside, and then gain-loss measures which focus on both the upside and the downside together, maybe with different preferences, but you've got gains in the numerator and losses in the denominator. We've then got prospect measures, measures based on prospect theory. We then have measures based on drawdown, and then we have measures based on extreme risk measures focusing on the tail of the return distribution. So now we get the top row of our periodic table with those 7 different measures actually: absolute, relative, downside, gain, loss, prospects, drawdown, and extreme. So we're beginning to get our space to fit in our return measures. Now let's quickly look at returns of a portfolio. Here we've got return portfolio A 7.9, portfolio B 6.9, benchmark 7.5. Obviously, if we ask which is the better performing portfolio, everybody would say portfolio A returning 7.9. Add a little bit of extra information though. Add this standard deviation, the variability of return, the risk. For portfolio A is 5.5, portfolio B is 3.2, and the benchmark is 4.5. I'm now going to make a big assumption. It's an obvious assumption, but I think we need to make it. I'm going to assume that everybody listening to this presentation is risk averse. That is to say, if they had 2 portfolios of the same return, they would naturally prefer the portfolio that was less risky. Now we prefer portfolio B. Portfolio B is less risky than portfolio A. So if we ask the question, which is the preferred portfolio now, we have 2 conflicting variables. It's more difficult to make the judgment. Well, if we have 2 conflicting variables, the natural thing is to plot one against the other. Absolute return at the vertical axis and the risk, the variability of return along the horizontal. We want to be in this top left-hand quadrant of this graphic, and so the gradient of these lines, that's from the fixed point here, which is the risk-free rate, to the combined return and risk of each of these portfolios in the benchmark. The further I'm in this top left-hand quadrant is the steeper gradient of these lines. This gradient has a name. It's called the Sharpe ratio, and it's an extremely well-known measure used by almost everybody in the investment industry. Another measure is the Treynor ratio. Less well used. I think most people are aware of it, and all I've done is I've relabeled one of these axes. I have the same label of the return axes, but along the horizontal I have just systematic risk as measured by beta, and that might rank these portfolios in a different order, and I still want to be in this top left-hand quadrant. So the steeper this line, the higher the Treynor ratio, the better. So those calculations very straightforward. Sharpe ratio, the numerator is the annualized return of the portfolio minus the annualized risk-free rate divided by the annualized standard deviation of the portfolio. The Treynor ratio, we have beta in the denominator, but we have the same numerator. Now, many people would criticize the Sharpe ratio for an assumption of normality, and we can defend that. We can actually adjust the Sharpe ratio for our preferences of positive skewness. We obviously like positively skewed returns and dislike negatively skewed returns. And we also like returns that have kurtosis less than 3. So kurtosis greater than 3, kurtosis measures the peakiness of the return distribution. A better way of describing it is the weights in the tails. So if it's greater than 3, there's more returns in the tails of the return distribution than a normal distribution. So we prefer kurtosis less than 3, and dislike kurtosis greater than 3, and we can reflect that in the adjusted Sharpe ratio. So it takes into account our preferences for kurtosis and low kurtosis and positive skewness. So now we can fill in that first column, all based on absolute returns. And so as you can see, the MAD ratio just takes the average calculated in the denominator by the mean absolute deviation, and it has the absolute measure in the numerator. Same absolute measure in the numerator, but now we're looking at variability of return, would give a Sharpe ratio. If we adjust the Sharpe ratio just for skew and not kurtosis, just skew, then that would be our third one down here, and then the fourth one is just for kurtosis skew as well, and that would be the adjusted Sharpe ratio. And of course, if we're just looking at systematic risk in the denominator, that would be the Treynor ratio. So we're beginning to build our logical structure in our periodic table of risk measures. The next column, of course, is relative risk, based on measures relative to a benchmark. The most common risk measure there, of course, is tracking error, otherwise known as tracking risk, relative risk, or active risk. I tend to think relative risk is a better term. This is the standard deviation of excess return, measures the consistency of that excess return. Could be ex post or ex ante. It's frequently quoted both ways. It's normally annualized, and this leads, of course, to one of my favorite risk measures as an institutional asset manager. That would be the information ratio. So called because it includes a lot of information. It's the annualized excess return over the annualized tracking error. Any engineer would recognize this ratio as signal to noise. So information ratio, again, I've relabeled my axes. Of the vertical axis, I have excess return and not absolute return. And on the horizontal axis, I have the variability of excess return, tracking error or relative risk, as opposed to the variability of absolute return. My natural starting point's in line with the benchmark, so that's 0. The steeper the gradient, the better. And the measure of this gradient is the information ratio. So very similar to the Sharpe ratio. You will see plenty of negative information ratios, a topic of another discussion, but I think the negative information ratio is fine to use. Even though you're getting higher tracking error, will make that ratio less negative for any given negative return. I think it is far better to be inconsistently negative than consistently negative. So if you've got low tracking error and you're underperforming, that's the worst situation to be in. What makes a good information ratio? When anything above 0 is, of course, good, and about 70% of managers tend to underperform their indexes anyway, so anything above 0 is a good start. 0.5 is recognized to be really quite good, 0.75 very good, and 1 would be exceptional. This is real data from an old portfolio manager friend of mine. She was an excellent manager. This is our annualized, quarterly calculated, 5-year rolling information ratio, and she sustained it near to 1 or above 1 for a long period of time. And that's the only qualification I would add to this. You can get peaks of information ratios above 1, but to be a real top-class portfolio manager, you need to sustain your information ratio above 1 for a long period of time. And in a peer group of over 2,000 firms, this portfolio manager was 2nd percentile. You can adjust the information ratio in the same way as you can adjust the Sharpe ratio, and you can express preferences for positive skewness and low kurtosis, and that's called the adjusted information ratio. Appraisal ratio is a great measure, actually, seldom used, and it has Jensen's alpha in the numerator, and it has specific risk in the denominator. So essentially, we're stripping out any return from systematic risk in the numerator, and we are stripping out systematic risk by focusing on just specific risk in the denominator. So this tells us how much return we're getting for each a unit of specific risk that we're taking. And I think it's a great measure. It's very similar to the information ratio, but it's obviously using regression analysis and stripping out any return from systematic risk. So a great measure, not used as much as perhaps it should be. I'm just relabeling the axes with alpha up the vertical axis now, and specific risk along the horizontal. So you see in the main body of the periodic table, all these risk measures are the same design: a measure of reward up the vertical axis, a measure of risk along the horizontal axis, and we just relabel those axes to get our different measures in the periodic table. So now I've filled in the second column. Information ratio fits in with variability because it's standard deviation of excess return. We've then got skew adjusted information ratio, adjusted information ratio, and appraisal ratio. The first one there, batting average, is up for grabs. If anybody can think of a better statistic to put in there, then that's still one place where I'm not sure I've got quite the right risk measure in there, so any ideas welcome on that. Now let's turn to partial moments, downside risk, and again critics of the Sharpe ratio may well say, well, we're not concerned about any risk on the upside. Why would we be? It's risk on the downside that should concern us. Why penalize variability on the upside? And so the Treynor ratio ignores the upside completely and just focuses on the downside. The numerator is similar to Sharpe, but not quite. Rather than subtracting the risk-free rate, you subtract the minimum acceptable return in the numerator, which could actually be the risk-free rate, but it could also be 0 or another arbitrary number. And then in the denominator, you have downside semi-standard deviation, downside risk. And basically, it's the same standard deviation calculation, but for any event, any return greater than the minimum acceptable return, we're going to call it 0, and we're only going to include in this calculation returns less than that minimum return. So we're going to ignore any impact of upside risk. So we're going to count the same number of observations, but anything greater than the minimum acceptable return doesn't make a contribution to that variability calculation. So again, all that we've done is we've relabeled the axis here. We've got downside risk along the horizontal. Up the vertical axis, we've just got a different starting place, maybe, which would be a minimum acceptable return of 3%, and the Treynor ratio is just the gradient of this line. The steeper the gradient, the better. Turning now to upside and downside ratios, Amiga focuses on the events greater than the minimum acceptable return, the average of those events on the upside, called upside potential, and the average of those events on the downside, called downside potential. So it's a gain-loss ratio. In fact, it's been around a little while. Bernardo and Ledeutsch suggested this with the minimum acceptable return at 0. A little bit of arithmetic, you can actually show that the Amiga ratio is in fact, if you take Amiga minus 1, you get the Amiga Sharpe ratio, which is the same numerator as Treynor, but has downside potential in the denominator, not downside risk. If you want the full set of upside downside measures, volatility skewness is a measure we borrow from investment banks, looking at their trading variability, daily trading losses variability. Variability skewness is just upside risk over downside risk, so you're giving the same weight to the upside as you do to the downside. You can generalize these ratios. That's what the Kappa or Treynor-Ratio ratio does. It's the same ratio, it's just written up in 2 different papers. It's the same numerator as Treynor, but you can actually choose your preference for the moment in the bottom. So the higher the moment, the bigger the weight you're giving to those more extreme results. It doesn't have to be an integer. It could be 2.5, 3.5, 4.5. It's basically what you want to observe in your return distributions. So you basically ask your portfolio manager to maximize that particular statistic. The Finelli-Tbilisi ratio is the same sort of idea, except it's upside downside. You determine the moment on the upside, the moment on the downside. So if these were both 1, 1 and 1, this would be the Omega ratio. They were both 2. This would be variability skewness. I've not mentioned the ratio. It doesn't necessarily fit into my periodic table, but if this was 1 and this was 2, you'd get the upside potential ratio. So now we can fill in the green area in my periodic table. You can fill in those measures were just based on averages, those measures based on variability, measures to introduce skewness. There's a skew adjusted Treynor ratio. And then, because they're generalized ratios and can show any moment, I put those in the row for the 4th moment kurtosis, because it could be the 4th moment, although in truth you can put any moment you like in here. That's kappa on the downside and the finality ratio on the gain-loss ratio. Timing ratio is in there. That's based on regression analysis. It's actually separating the beta when market returns are positive from the beta when market returns are negative. And obviously, the higher the timing ratio, the better that you're able to position your portfolio when markets are going up or down. So that's based on systematic risk, and it's sort of market gains in the numerator and losses in the denominator. Prospect ratio. Prospect ratio has been around a little time now, and it's built on the premise, the prospect theory, which suggests that investors dislike losses more than they like the equivalent gain. So you can factor that into your ratio. And basically we've done that here. We've said that investors dislike losses 2.25 times as much as they like the gain. It's got downside risk in the denominator here. You can build various different prospect ratios. There's a skew adjusted prospect ratio. The new prospect ratio, which is a statistic I've seen published just recently, that factors in the 4th moment of kurtosis as well. The K ratio is a ratio that's a regression analysis of cumulative return against time. So I've slotted that in there, but it really doesn't have a great deal to do with prospect theory. That's why it's a different color and a thicker black line around here. And again, return to duration. I thought it should be in the periodic table in here. It's systematic risk measure. It's in the right row. I'm not sure it's in the right column with downside. So a few improvements yet could be suggested to this table, I suspect. Drawdown is a very simple measure. You might measure it differently if you've got daily and monthly data, but that's a different discussion. But here there's I would define a drawdown as a continual series of negative returns. So these are the cumulative returns of a hedge fund manager, let's say, and this would be the first drawdown in a return series. Then you've got another peak and a valley here. That would be drawdown number 2, bit of a recovery, and then a fall. That would be drawdown number 3. The worst possible thing you could do with this manager would be buy at the peak, sell at the valley. That would be the maximum drawdown. And that's a statistic that actually quite a lot of people relate to. What's the most amount of money I could lose with this manager? Well, that would be the maximum drawdown. And there are various drawdown statistics. Kalmer ratio, same numerator as Sharpe, but it has the maximum drawdown, the denominator. Sterling has the average drawdown, and the Burke ratio is a variance calculation of drawdown. So we can fit these measures into our periodic table as well. By the way, Kalmer is not named after Mr. Kalmer. It comes from California Managed Annual Reports, always calculated for 3 years. I've taken the liberty of introducing the risk-free rate in the numerator just to make it consistent with our other Sharpe type measures. Sterling and Burke ratios are typically calculated over 3 years as well. They don't include all the drawdowns in the averaging and variance calculations, just the largest individual ones, so the top 3, the top 5. So just be careful about that if you're using those statistics. Statistics that, frankly, I don't think anybody's using, but I just love them because I love their names, are the pain and ulcer indexes. And they reflect the pain and worry of a portfolio manager or an investor from a previous high watermark. So the longer you're underwater from a high watermark, then the more painful it is. The pain index simply calculates each drawdown since the peak, and so it measures both the depth and the duration of the return since the high water mark, and the Ulster Index just does a variance calculation on the same data. So here we've got a peak in our return series, and basically every month we're underwater, it's still painful. So we're underwater is getting very, very, very painful now, very, very painful. A bit of a recovery, but we're still in pain because we're still below the high water mark. And only when we get to this point here do we get any relief from the pain. So basically the pain index is calculating the area under this line. Look at it as a bit of a lake in a mountainside, if you like. The Ulster Index gives greater weight to these bigger troughs by squaring those calculations than taking the square root. There are Sharpe type ratios based on pain and Ulcer. Pain ratio as the pain index in the denominator, the Martin ratio as the Ulcer Index in the denominator. So we fit those into our sixth column, a drawdown column. Sterling is an average, Burke's a variability variance calculation, so they would seem to fit logically there. Calmer, pain and Ulcer, I struggle to know which row to put these into. So it's definitely they're in the right column. Are they in the right rows? I'm not entirely sure. Okay, extreme risk, value at risk. Value at risk is a relatively simple statistic invented for investment banks looking at their daily trading risk, and it looks at the extreme of the returns in the return distribution. And so it might be described as the maximum loss in cash terms over a finite period given a certain level of confidence. Our confidence level might be 95%. So if I said my annual value at risk was $5 million, only once in 20 years do I expect to lose more than $5 million. People understand that. It's typically calculated ex ante. Easy for lay trustees to understand and to misunderstand, unfortunately. As performance measures, we probably should say return at risk, because we don't talk about values necessarily. We don't say 5 million, we say 3%. And the opposite of value at risk, of course, in the extreme right, the extreme gains of the return distribution, is potential upside. We can calculate VAR using a variety of ways: historical simulation, Taylor simulation, or parametrically. Modified VAR is a parametric measure where we can modify for kurtosis and skewness in the calculation and with different confidence levels as well. There is a Sharpe type measure based on VAR. That would be the same numerator as Sharpe, but with value at risk in the denominator along that horizontal. And of course, same measure at the vertical axis, but along the horizontal axis you now have VAR. Modified Sharpe ratio just has that parametric calculation of VAR using Skewness Kurtosis in the denominator on that horizontal line. VAR is an unsatisfactory measure in many ways, and conditional VAR is a better measure. Other names for that are expected shortfall or tail loss. VAR just tells you where this 95th percentile is, or whatever confidence level you're using. It doesn't really tell you much information about the distribution of returns in the tail, those extreme results. And we ought to be very concerned about that. And so the measure that does actually take this into account is conditional VAR. That's the average return in the tail, conditional on the return being more negative than the value at risk. So we are getting some information. It's a more coherent risk measure. It's also an additive measure. So in many ways, it's much better than VAR. There's a conditional Sharpe ratio, of course. Same numerator as Sharpe, but conditional VAR in the denominator. And Rachev ratio is a weird ratio, actually, that looks at the extreme gains, the equivalent of conditional VAR on the extreme positive against tail loss, another name for conditional VAR, in the left-hand side of the return distribution. So you're ignoring most of the distribution, just focusing on the extremes. The higher the Rachev ratio, the better. Tail risk, and some other people might define tail risk differently, but tail risk is a variance type calculation in the tail, conditional on the return exceeding or being more negative than the value at risk, and tail ratio is the same numerator as Sharpe, but as tail risk in the denominator. So now we're building the very far right-hand side of our table, and so we're not relating to the left-hand side now. I'm going to put these extreme statistics on the right. You might have thought I'd started with VAR at the top here, but conditional VAR is an average calculation in the tail, and tail risk is a variability calculation, so it makes more sense to start with these, and they correspond to the conditional Sharpe ratio and the tail ratio, and then I've just put in VAR and parametric VAR to complete this column really. We now turn to risk-adjusted returns, and I think one of the better risk-adjusted returns, one of the better measures, is M-squared. Another criticism of Sharpe ratio would be, I know 0.7 is better than 0.5, but I don't know how much better it is. Well, M-squared answers that question. Basically, you draw a straight line through the risk of the benchmark, and you're interested in this intercept point here. This is the return of a portfolio, return of a portfolio with the same Sharpe ratio of portfolio B, but at the risk of the benchmark. So that's a genuinely risk-adjusted return. So you're taking the Sharpe ratio and you are converting it to a metric we all understand, which is return. And obviously portfolio A falls underneath the benchmark return here. You come down the Sharpe ratio, find the intercept point here, and obviously you can see portfolio A is not as good as portfolio B on a risk-adjusted basis. So Sharpe ratio, we've seen that calculation before. M-squared, you might see it in most textbooks described this way, which is perfectly fine. I prefer to present it this way because it captures the geometry of the previous slide. To analyze return of the portfolio plus the Sharpe ratio multiplied by the risk of the benchmark, the risk of the market, minus the risk of the portfolio. So if the portfolio is riskier than the benchmark, the market, there's a penalty. If it's less risky, there's a reward. Up to now, very few of these risk measures are my idea. I claim credit for this one. And all I've done here is I said, okay, well, the adjusted Sharpe ratio is just another Sharpe ratio gradient, but adjusted for skewness and kurtosis. So actually, if we now find that intercept point with the risk of the benchmark, we get a return which is adjusted not just for risk, but is adjusted for our preferences for skewness kurtosis as well. So what we've done, we've taken all four moments of the return distribution, the average, the variability, the skewness and kurtosis, and translated it to a metric we all understand, which is return. So I think that's a great statistic. I'm not sure many people are using it yet, but I'd certainly recommend it to you. So those risk-adjusted returns, I've put that on the right-hand side there, obviously starting with excess return, with just the return just for the benchmark, and then as you go down, you've got M-squared, you've got skew-adjusted M-squared, you've got just M-squared just for skew, and then adjusted M-squared adjusted for kurtosis, skewness, and variability as well. And then, of course, alpha is an excess return adjusted for systematic risk or beta. So that fills in separate type of statistics. These are risk-adjusted returns on the far right-hand side there. And then there are a whole series of statistics with just sort of miscellaneous measures which are neither good nor bad, but help us understand better the return distribution of the portfolio. Rachev test is a hypothesis test for normality. Feeding skewness and excess kurtosis in this calculation. If this exceeds 5.99, you reject the hypothesis that the return distribution you're looking at is normal, and that might be relevant if you're assessing the performance of a hedge fund manager. You expect the return distribution to be non-normal, and if it's not, that might become a problem. Hurst Index, Hurst was a civil engineer working in Egypt in the 50s, and he was interested in placing dams along the River Nile, and he wanted to measure the flow rates of water, and he invented a statistic to help him. Log R over S, the rescale range over log N. Great statistic. I haven't got too much time to talk about it now, but if the result is between 0.5 and 1, it means the return series you're looking at is persistent. There's memory there, okay? and tending to travel in the same direction. If it's 0.5, it means the return series is totally random, and between 0 and 0.5, it means it's anti-persistent or mean reverting. These things are neither good nor bad, but it does give you extra information about the way the portfolio manager is adding value, the way his returns are shaping up. Bias ratio is a ratio I haven't actually used, but I have come across in academic literature. I quite like it. It's simple. It's just basically a count of returns that are strictly zero and less than 1 standard deviation away from zero on the positive side, divided by returns that are less than zero and within 1 standard deviation of zero. And basically, if you've got a stale pricing, if you've got stale prices or subjecting pricing policy or even worse, fraud, you're going to have a high bias ratio as portfolio managers reluctantly don't allow losses to come through. So you don't get a symmetrical position around zero. And so in some very high profile fraud cases, you might have seen that the bias ratios are very high. Now, a genuine high bias ratio would be a good thing, but it might also be a warning, a red flag to do a bit more due diligence if you ever come across it. Risk efficiency ratio is a great ratio, not because it gives you a lot of information, but because it forces ex post and ex ante calculations together. So you compare ex post tracking error over ex ante, or VAR, or variability of return. It's your observed tracking error over your forecast tracking error. It measures the quality of your tracking error forecast. You'd expect it to be 1. If it's much different from 1, if your realized risk is much more than your forecast risk, then you might have a problem. And because we tend to calculate these numbers in different parts of the firm, performance measures calculate ex post, risk managers, portfolio managers calculate ex ante, it forces these two teams to talk to each other and figure out who's wrong if there's a big difference between the two, and that might lead to some interesting conclusions. So that really fills up the periodic table for now. I've got those miscellaneous risk measures along the bottom. I hope you find that's useful, and I'm looking forward to questions if you have any. Ken, do we have any questions?
Thanks so much, Carl. Yes, we have a few questions. Some of them are very similar, so I'm going to combine a couple of them in our question I'm going to read to you now. Carl, which risk measure is best? For which of these measures that you've discussed do you see the most demand by clients? And for which measures that you went over do you see little or no demand at all from clients?
Yeah. Many of these risk measures, frankly, are not used. The most common risk measures are, of course, Sharpe ratio, information ratio, to a lesser degree, Treynor ratio and Kalman ratio. So those are the most often measures I see used. I think the question about which measure is best, it depends. Risk is like beauty, it's in the eye of the beholder. You've got to determine what your preferences are and figure out which sort of reward you want and which sort of risk you're concerned about. So that's why I've designed this risk table, really, because you can see how they all fit in, and you might want to be elsewhere on this table. You might be concerned about the maximum amount of money you might lose, which would be Kalman ratio, as opposed to Sharpe ratio, which is just the variability in the along that side, also Treynor, which is downside. So the best really depends on personal preference, and I've tried to fit in the maximum number of risk measures into this table, frankly.
Great. To what degree do you see the risk and performance functions merging, to your point about different stats being used by these two groups?
Yes, my ideal format for my ideal structure for an asset management firm would have obviously a front and a back office and a very strong middle office as well. And I think in the middle office should sit the risk function, or the risk control function to be more precise, and the performance measurement function. And I would see a lot of movement between those two. I think they have similar skill sets. They have a similar need to understand the management of the portfolios, and they provide similar support to the portfolio managers. I think portfolio managers are risk managers, so you've still got that risk management activity taking place in the front office, but I think it's being monitored in the middle office. So I think the risk control, performance functions, I think they fit together with other similar functions like legal, internal audit maybe, to a lesser degree compliance, and I think they all fit into the middle office, and I'd like to see more of that. Obviously in big firms you can see that. In smaller firms, actually the middle office may consist of one or two people that are working together, and that they don't call themselves the middle office, but in effect that's what they end up doing. Clearly they shouldn't report to the front office, and they're monitoring the back office as well. So ideally, I wouldn't have risk control and performance reporting to the back office either, although I do know that's quite common.
Great. Carl, which measure would you use for the calculation of performance fees?
Well, if I was going to use them at all, and I have some doubts about performance fees, I would use the adjusted M squared or M squared. So most performance fee structures I see have no adjustment for risk at all. And so we're giving people a free ride on risk. I think we shouldn't. M squared certainly adjusts for risk, and adjusted M squared adjusts not just for risk, but it adjusts for Skewness Kurtosis as well, and it converts to a return metric against which most performance fees are calculated anyway. So I would use adjusted M squared or adjusted information ratio if it's relative return we're looking at against the benchmark.
Okay, Carl, we have time for one last question. Is the table now finished and complete?
No, it's not. And there are a few in here where I'm not sure drawdown fits in as well as it might. I'm not quite so convinced on batting average up here. When the original chemical periodic table was devised, new elements came along, unstable elements, and I'm perfectly happy to see suggestions to changing this. I would love for somebody to devise some sort of mathematical notation which would describe these risk measures as well, and so we could put some notation in here, and that would be fantastic. So I think those would be good contributions.
Awesome. Thank you very much, Carl. That was great. And as our participants will see on their screen, we have Carl Bacon's contact information, so I'm sure Carl would welcome, as he just indicated, any feedback on his table. That would be great. So on behalf of BSAS, I'd like to thank Carl Bacon, and I'd like to thank you all for joining us today. Everyone will be receiving a BSAS webcast survey via email, and we would appreciate it if you can complete that online. Thank you, everyone, and enjoy the rest of your day.
Thank you very much.